Let me ask you something honest. The last time the market dropped, really dropped, what did you feel first? Was it curiosity? No, it was panic. Your stomach dropped before your brain even understood the number. And here's what nobody tells you about that feeling. It's not a weakness. It's not stupidity. It's not because you didn't study enough charts or watch enough YouTube videos. It's because your brain was never built for investing. It was built for staying alive. And a brain built for survival is a terrible investor. The smarter you think you are, the more money you'll lose. That's not a joke, that's science. In this video, I'm going to show you 5 traps that are quietly draining your wealth right now. Not because you're careless, but because your brain is working exactly the way it was designed to, just in the wrong direction. And the last one, the 5th trap, most people don't even realize it's happening until it's already over. Stay till the end. That one will change how you think about everything. In our previous video, we talked about how real money mistakes don't look like obvious greed. They look like normal decisions made at the wrong moment for the wrong reason. We talked about Aversion, the guy with the steady monthly investment plan, the disciplined approach, and how one emotional moment ruined years of good habits. Today we go deeper because having a plan is only half the game. The other half is understanding your own mind, and most people never even play that half. You can have the best investment account, the best mutual fund, the best monthly savings amount, and still lose money, because the enemy isn't out there in the market. The enemy is inside your own head. 5 traps, 5 mistakes, 1 video, let's go. You remember November 2021, Paytm's stock launch. Everyone was talking about it. Your office WhatsApp group was on fire. Your cousin applied. Your colleague applied. Your neighbor, who had never invested in anything, applied. And you sat there thinking, what if this is the one I miss? So you applied too, not because you read the official company documents, not because you understood how the business works, but because the silence of not applying felt unbearable. That feeling has a name, FOMO, fear of missing out. And in investing, it is the most expensive 4-letter word you'll ever feel. Here's what FOMO actually does to your brain. When you see others making money, your brain reads it as a threat, like food being taken from your plate. Your body goes into panic mode. Your stress hormones shoot up. Your calm thinking shuts down, and you act. Not because the investment is good, because the fear of being left out is worse than the fear of losing money. Paytm's stock opened 27% below the launch price. It kept falling, and the people who chased the hype, they didn't just lose money, they lost 3 months of savings, 50,000 gone, not because they were stupid, because the fear was louder than the logic. The fix isn't to ignore every opportunity. It's to use a 48-hour rule. Any investment that needs you to decide right now is probably designed to scare you into acting, not to actually build your wealth. If the opportunity disappears in 48 hours, it probably wasn't an opportunity. It was a trap. But FOMO is actually the weakest of the 5 traps. The next one, you've been carrying it for years and you don't even know it has a name. You bought a stock at rupee 800. It fell to rupee 500. Someone tells you, sell it and accept the loss. And something in you refuses. Why? Because rupee 800 is stuck in your brain as what that stock is worth, even though the market and the company itself disagrees. That's called anchoring, and it's sneaky because it doesn't feel like a mistake. It feels like patience. It feels like loyalty. It feels like you're just waiting for things to go back to normal. But here's the truth. The stock doesn't know what price you bought it at. The market doesn't care. The only person being controlled by that 800 number is you. Studies on everyday investors in India show this clearly. The first price you see becomes your reference point for every decision after. Not because it's accurate, because it's the first number you saw. Your brain treats first as true. This is how people hold a stock for 4 years at a loss. Not because they believe in the company, because the thought of selling below their buy price feels like admitting they were wrong. And protecting the ego costs more than the stock. The fix is simple but uncomfortable. Ask yourself this every time: if I didn't own this stock right now, would I buy it today at this price? If the answer is no, the first number you saw is making your decisions, not you. Anchoring is about the past controlling your present. But the next mistake, it's about something completely different, something that hits even harder. Because it's not about what you think, it's about what you feel. You've had this experience. Your monthly investment plan is giving 14% returns every year. Consistent, slow, boring, good. But one month your total savings drop 8% during a market crash. And suddenly, even though you're still in profit overall, you feel like you're losing. You check your investment app at 2 a.m. You refresh it again at 7 a.m. You think about stopping your monthly plan. Nothing changed in your actual money situation, but something broke in your head. A Nobel Prize-winning psychologist named Daniel Kahneman proved this. The emotional pain of losing rupee 1 is twice as powerful as the happiness of gaining rupee 1. Twice the same amount, double the pain. Now here's the twist, and I need you to really sit with this. Fear of loss doesn't just make you hold bad stocks too long. It makes you avoid good investments entirely. That IT sector mutual fund you kept putting off because, what if the market falls right after I invest? That monthly investment you never started because you didn't want to see a red number in week 1, that's the same fear. It's not just a trap that makes you hold bad choices. It's the trap that stops you from becoming a winner. The fear of a possible loss is quietly costing you more than any actual loss ever did. During the COVID crash in March 2020, the Indian stock market fell nearly 38%. Thousands of investors, salaried people with good intentions, stopped their plans or worse, sold everything. Some moved everything into a fixed deposit. And then the market came back fully, and more, within 18 months. The people who stayed, who didn't let the pain of that 38% drop take over their logic, they didn't just recover, they multiplied. The fix: never make an investment decision when you're in emotional pain about the market. That is the worst possible moment your brain has to offer you. 3 down, 2 to go. And the next one is the most embarrassing one, because when I describe it, you're going to think of at least 3 people you know, and then slowly realize you might be one of them. Your friend messages you on WhatsApp: "Bro, this small company stock is about to triple, don't miss it." And he sounds confident, and he's already bought it, and 2 other people in the group are talking about it, and the stock is already up 12% this week. So you do what feels safe, you follow. Not because you researched, because the crowd felt like information, the crowd felt like proof. It wasn't. Following the crowd is the trap that disguises itself as being smart. It feels like you're making a good move, you're watching the market, watching other investors, watching people who seem to know things. But those people, they're watching other people too. And at the end of this chain, there's nobody who actually knows anything, just fear moving faster than thinking. Research on Indian investors who use apps like Zerodha and Groww found that FOMO and WhatsApp forwards are the main reasons people follow the crowd in India. Not research, not analysis, WhatsApp forwards. Think about that for a second. The Adani stock rally of 2022 is a real example. Regular investors piled in because it was everywhere: news, social media, office conversations. India's stock market regulator, SEBI, had already raised concerns. The company's numbers were being questioned, but the crowd moved anyway. Because when everyone is running in the same direction, standing still feels like losing. Here's what nobody tells you about following the crowd. By the time you hear about a stock from a WhatsApp group, the people who knew early are already planning to sell. You are not getting in early. You are the last person in before the crash. The fix is uncomfortable. The louder everyone is about an investment, the more quietly you should think before deciding. Noise is not information. popular is not the same as profitable. 4 mistakes down, and now we reach the 5th. This one is different. This one is invisible, because unlike the others, this one makes you feel like you're doing everything right. You've done your research, you like this company, you've read 2 articles, watched 3 videos, and listened to 1 podcast. They all say it's a strong buy, you feel confident. So you invest. And then, a week later, a report comes out that raises some warning signs about the industry, and you read the headline, and you move on. Because deep down, you've already decided, and you're just looking for more reasons to feel right. That's confirmation bias, and of all 5 traps, this one is the most dangerous, because it's the only one that wears the mask of doing your homework. Here's how it plays out on Zerodha or Groww. You buy a stock. You immediately start following that company on social media, but your brain has a filter now. The good news feels important. The bad news feels like an overreaction, feels like it's from someone who doesn't understand the full picture. You're not reading the market anymore. You're building a case for a decision you already made. Research shows that investors with confirmation bias are more likely to hold on to losing investments too long because they keep finding reasons why the bad news doesn't matter. It works together with fear of loss. It makes anchoring worse. It makes following the crowd worse because you only listen to people who agree with you. All 5 mistakes in this video, confirmation bias can lock them all in place. It is the glue that holds all the other traps together. And I want to say this honestly, I've been here. The smartest investors I've read about have been here. This trap doesn't target people who are careless. It targets people who are confident enough to have already made up their mind. The fix is this: before you invest, spend 30 minutes genuinely trying to find the reasons why you could be wrong. Find the best argument against the investment. Read the side that says it's a bad idea. If you can't find one, you haven't looked hard enough. And if that negative side sounds stupid to you before you've even read it, that's the bias talking, not you. So here's where we are. FOMO makes you chase, anchoring makes you freeze, fear of loss makes you hide, following the crowd makes you follow, confirmation bias makes you blind. 5 traps, 5 different doors, 1 destination, you losing money that you worked hard to earn. But here's the thing I want you to hold on to when this video ends. Knowing the name of the problem is not a consolation prize. Knowing the name of the problem is the actual fix. The moment you can name what's happening, this is FOMO talking, or I'm stuck on the price I bought at, you create a gap between the feeling and the decision. And in that gap lives everything. That's where good investing actually happens. Your brain will still feel the FOMO. It will still panic at the dip. It will still want to follow the crowd. That's not going to change. But you now know what's driving it, and you can pause, and in that pause, you make a different choice. That's the whole game, not perfect decisions, better pauses. Markets have always recovered. The Indian market in 2020, the mid-size company crash of 2018, every dip that felt like the end. The people who built wealth weren't the ones who predicted the recovery. They were the ones who didn't let their brain pull them out right before it happened. You now know more about your own mind than most investors will spend a lifetime ignoring. That matters, don't waste it. If any one of these 5 felt like a mirror, drop it in the comments. Which trap has cost you the most? No judgment here, this is a safe space, and the most honest comment might be the most helpful thing someone else reads today. If you're new to this channel, Part 1 is already up. Watch it. It sets the foundation for everything we're building here. And in our next part, we are going to talk about the one investor mindset that quietly destroys more wealth than any bad stock pick ever could. It's not about what you invest in, it's about who you believe you are as an investor, and that story you're telling yourself. It might be the most expensive story you own. Subscribe, notification on, I'll see you there.